attorney Laura Anthony, founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is the first in a LawCast series talking about the new amendment to the SEC definition of a smaller reporting company. On June 28, 2018, the SEC adopted the much-anticipated amendments to the definition of a smaller reporting company as contained in Securities Act Rule 405, Exchange Act Rule 12b-2, and Item 10F of Regulation SK. The amendments come almost 2 years to the day since the initial publication of proposed rule changes. Among other benefits, it is hoped that the change will help encourage smaller companies to access U.S. public markets and go public via IPO. The amendment expands the number of companies that qualify as a smaller reporting company and thus qualify for the scaled disclosure requirements in Regulations SK and SX. The SEC estimates that an additional 966 companies will be eligible for smaller reporting company status in the first year under the new definition. As proposed and as recommended by various market participants, the new definition of a smaller reporting company will now include companies with less than 250 million public float as compared to the 75 million threshold in the prior definition. In addition, if a company does not have an ascertainable public float or has a public float of less than 700 million, a smaller reporting company will be one with less than 100 million in annual revenues during its most recently completed fiscal year. The prior revenue threshold was 50 million and only included companies with no ascertainable public float and not a revenue figure. Once considered a smaller reporting company, a company would maintain that status unless its float drops below 200 million if it previously had a public float of 250 million or more. The revenue thresholds have been increased for requalification, such that a company can requalify if it has less than 80 million of annual revenues if it previously had 100 million of revenues or more, and less than 560 million of public float if it had previously had 700 million of public float or more. The SEC also made related rule changes to flow through the increased threshold concept. In particular, Rule 3-05 of Regulation SX has been amended to increase the net revenue threshold in the rule from 50 million to 100 million. As a result, companies may omit financial statements of businesses acquired or to be acquired from the earliest of the 3 fiscal years, otherwise required by Rule 3.05, if the net revenues of that business are less than. Furthermore, the conforming changes include changes to the cover page for most SEC registration statements and reports, including Forms S1, S3, S4, S11, 10Q, and 10K. The new rules did not change the definition of either accelerated filer or large accelerated filer. As a result, companies with 75 million or more of public float that qualify as a smaller reporting company will remain subject to the requirements that apply to accelerated filers, including the accelerated timing of the filing of periodic reports and the requirement that accelerated filers provide the auditor's attestation of management's assessment of internal controls over financial reporting as required by Section 404B of the Sarbanes-Oxley Act. However, Chair Clayton has directed the SEC staff to make recommendations for additional changes to the definitions to reduce the number of companies that would qualify as accelerated filers and thus have to comply with Sarbanes-Oxley Section 404B. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance and producer of LawCast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.